All right, all right. What's up, everybody? Welcome in, welcome in. I am so sorry. I know I'm about 15 minutes late or so. Dude, everything that could have went wrong over the last 15 minutes went wrong. Listen to this real quick. Before we get into the numbers, you got to hear this. First of all, I was in sparring last night. I'm a professional kickboxer, by the way, so I fight people in a cage for money sometimes. I know it's weird. Dude, I got smashed with a knee to the eyeball. So that's that, by the way. Bro, okay, my alarm goes off. 5:45 a.m. Okay. I get up, I'm good. I come up to my computer, I turn it on, and it says forced update, blah, blah, blah. It was updating already. I guess it like did it at 5:30 or something. Like, no, it's fine. It finished updating at no, it was 5:30. Live stream was supposed to start at 5:45. It finishes updating at 5:40. Boom, perfect. We're good. We're gonna get on live. I go to turn it on, I check. Internet has the little thing through it, but my internet's on. So I'm like, what is going on here? Since the update, my computer would not connect to the internet. So I'm troubleshooting, trying to figure it out. It says that like my network, hard drive, blah, 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 messed up. Whatever, it needs to reset. Okay, fine. I do that. It finishes like 10 minutes ago or so. Computer gets back on, power goes out. I was like, bro, what is going on today? So nonetheless, it took me a second, but we're back. We're here. And we got a bit of an interesting stream today, folks, because the numbers are in. The numbers are in. We have SoFi's Q2 earnings in. I wanted to watch them with you guys as they released, but I was not given that opportunity because, again, literally everything that could go wrong did go wrong this morning. We got SoFi's price down in the pre-market, currently at $16.17 following that earnings report. Still a little bit early, so we'll see how the market responds when it wakes up. Most people aren't awake yet, but you and I are because we are weird. So let's get into it. Let's get into it. So let's talk about the numbers, folks. Let's go through this whole thing real quick. Let's go through this whole highlight. And then I'll go through, I have a little presentation for you. Of course, I have these automatically being made, okay? So record adjusted net revenue of $1.2 billion, up 40% year over year. An absolute record-breaking quarter. Let me see if Qualtrim is updated real quick, by the way. Might not have updated yet. No. Okay. Not yet. All right. So not yet. Record adjusted net revenue of $1.2 billion, up 40% year over year. Beat, I believe, let's see, we were looking at 1.1 what? 1.21. 1.11 was the expected revenue, came in at 1.21, beat by 8%. Very good. Love to see it. Adjusted net income coming in at $160 million, 13% GAAP net income margin, which is okay, and an adjusted EPS of 12 cents, which is, of course, the 11th straight quarter of profitability. Coming in at 12 on the EPS, beat by a little bit there. What's that? Like nearly 10%, 9%, 8%, something along those lines. So we see that adjusted EPS, earnings per share, beat as well. Fee-based revenue increased 22% from last quarter to $472 million, representing 39% of adjusted net revenue, with their cash revenue of $1.2 billion in line with total adjusted net revenue. Now, this is what gets really interesting to me, and they did something a little bit different. So I'm going to have to go into this in a second. But their financial services and tech platform revenue contributed $551 million of adjusted net revenue, which is up about 17% year over year, which is very strong, very strong. I know Galileo didn't hit like an all-time high, but it's recovering. And record loan originations of the $14.8 billion in the quarter as well. Credit remains strong and in line with expectations. Deposits grew $5.3 billion to $46 billion, and tangible book value growth of $226 million to $9.5 billion. So basically, a very good quarter. A very good quarter. And you know why this is a good quarter? Because, look, some people are going to look at these numbers and say, oh, well, it's not that great. They only beat by 8% on adjusted revenue. They only beat adjusted EBITDA by, 28 million, which is a lot. But their revenue growth was only 40%. It wasn't 30%. No, folks. This isn't AI. This isn't the AI narrative. All right. They have a little bit of different stipulations put on them. A beat of 8% on adjusted revenue, 9% on EPS, what's that? 30% on revenue growth, 28 million on EBITDA. That's good. That's good. The only thing that I am like a little bit like, the only thing that's like, is their net income. Their net income did fall a little bit flat. So it's kind of like, you definitely want to see those margins increasing, but obviously things are getting a little bit difficult out there. And so you are going to notice that their margins may not grow as fast as you would hope that they would. But all in all, this is a fantastic, in my opinion, at least, an absolutely fantastic earnings report. I just think a lot of people get it messed up or they get it confused because they see what happens in AI, right? They see Micron beating by whatever, name a percentage, right? It depends on the month. And they see all of these companies blowing expectations out of the water. But you have to remember, those are companies that are in an exponential growth period right now, right? We are seeing them growing at exponential levels. SoFi is a company that's been around for years at this point, 5 years now, publicly at least. And they don't they're in a more boring sector. They're in a more boring business. They're not just going to blow past the expectations. Their EPS isn't going to come in at 19 when expectations are 11. That's just not reasonable. Okay. And so all in all, this is a great reading. And if we actually go look, this is another beat for SoFi, which is very good stuff here. This is the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 straight beat on earnings for SoFi, which is really damn good. And you love to see it. You love to see it. And look, I mean, this is kind of similar, like with their revenue in their previous earnings report, they beat by 3.7%. Before that, 3.6%. Before that, 6%. Before that, 6%. 4.2%. 9.5%. 9.9%, 5%. So, even in these moments where you see it rallying, you see it going crazy when it was at its peak, we're only talking about, what was this, 4 to 9%. Or so. Realistically, even in here in 2025, they were only beating by 6%, 6%, 4%, 9%. You know what I mean? So it's a different ball game. It's a whole different ball game. Okay. And that's why I honestly do think this one's good. And I'm in a spot where I'm like, I dare the market to treat SoFi badly because of this. I dare the market to treat SoFi badly because of this. That would be quite interesting to say the least. Now, let's talk about total originations, because this is really where a lot of the interesting thing will come from. And this is what the market pays attention to. Okay. And this is what the market cares about. This is like the heart of SoFi. So total originations hit 14.8 billion, blowing past last quarter's 12.18 billion record, which is of course up 21% sequentially and 69% year over year. Personal loans at 10.7 billion, which includes 3.1 billion through the loan platform business, which is great because they've been building that out recently. Student at 2.7, home at 1.4. Records in all three categories, with lending adjusted net revenue 712 million, up 59% at a 56% contributing margin, meaning that across all of it, all the personal loan, all the different loan originations hit records. They all hit records. SoFi is growing. It's growing. And although the bears have been out there and they're wanting to, they can't wait to see the day that SoFi's loan originations aren't performing well. They can't wait to see the day that SoFi's, missing on just one. If it's personal loans or whatever, they don't care. They just want one of them to miss. Although that's what they want, they didn't get it. Personal loan charge-offs fell to 2.62% from 3% last quarter alone. You strip out delinquent loan sales, and it still dropped 3.7% from 4.4%. Student loans, 0.61%. 90-day delinquencies improved to 0.4% from 0.47%. Borrowers are prime. While everybody's saying, no, nobody's going to be able to pay SoFi back, they're not going to be able to pay on their loans, borrowers are prime right now. $150,000 average income, 742 average FICO score, and the 2022 to 2025 vintages are now running 175 basis points better than the 2017 cohort, meaning that the gap has widened 8 quarters straight across 2 years now. While everybody wants SoFi to be shrinking and not growing, they're just growing. And people don't care, people don't appreciate it, people don't respect it because its price is down, because it got too high, it ran too hot. But now I think it's running too cold. And we have a SoFi currently in the pre-market down to $16.26. And listen, we are in a corrective period in the stock market in general. SPY is correcting. That is just what is happening. Meaning that, no, the whole market isn't feeling positive. The market isn't running up. The market isn't feeling euphoria. So a more high beta company like SoFi is going to struggle to grow in a moment like this. But I just can't help but think, I can't help but think that SoFi is going to catch up at some point. I can't help but think, especially if it decides to give us one pullback into the say $10 to $14 range, anywhere down here, that it's gonna catch up and we're gonna get a freaking 100% move. Or so I can't help but think. And these sorts of things are what I'm looking for. These sorts of things are what I'm looking for. Now, this is one thing that was interesting to me. You know what I was hoping they did? I was hoping they went in and they gave us the exact number on their crypto revenue. I don't believe that they did. I didn't see it. I didn't see it. And maybe I missed it. Give me 1 second. Because it looks like they combined their financial services into one. Maybe I missed it. Let's see. No. Ooh, tech platform accounts up to 135 million in 2026. Not bad. No. Here's guidance. Let's see. Give me 1 second. No. Okay. So I guess we're gonna have to just listen in. I'm sure someone's gonna ask about it. I guess we will have to listen in on the call. The call starts in 30 minutes. We'll listen in because I'm not saying. Let me see. Yeah, no, I'm not seeing. So the last quarter, what they did is they broke down specifically how much they made from their crypto transactions and their stable coin. I don't believe Q2 crypto earnings. Okay. Damn it. Okay. SoFi Technologies did not break out specific standalone crypto earnings or revenue line items in its Q2 2026 financial results. Instead, reporting record overall metrics dominated. That's sus to me because last quarter they did about $850,000 in net income from their crypto transactions. Why would you not show it again this quarter unless maybe that's just not your approach. You just want to tie it all in and you don't want to have it isolated off. But I feel like that is a little bit suspect. Makes me think like maybe they're not doing great on the crypto sides, but it's definitely worth paying attention to. It's not material enough to break out as a separate reporting segment in the Q2 headline. Okay. Hopefully someone asked about it. Hopefully someone asks about it. Because this matters to me personally. I know some people it doesn't matter to. It does matter to me personally, just because I believe that SoFi is going to make a lot more money from the crypto platform than people think. Like their stable coins and their crypto transactions, I think they're going to make a lot more money from it than people realize. And I think that alone is going to contribute a ton of value to their multiple. Because we've seen it, we've even seen it with companies like Robinhood. When you're in a bull market and you're making money from crypto, people give you that short-term multiple boost. I mean, we saw Robinhood run from April 2025 up 400%, up to $156 per share, and that was mostly because of their transaction revenue. A lot of which, or a good bit of which was from crypto as well. So we've seen it from Robinhood. I think it's going to happen the same for SoFi. I think when the crypto bull market comes around, SoFi is going to make a lot of money off their stablecoin and a lot of money off their lending services attached to crypto and transactions as a whole. And I'm telling you, but it's obviously worth paying attention to. Maybe my read is off here. We'll see. I don't think so, but we'll see. Okay. Yeah. Okay. So let's get into Galileo. So this is like the other side of things. Okay. So you remember how I told you just now that I believe that the crypto transaction revenue, stablecoin revenue, lending for stablecoins, etc. I think that's going to contribute a ton of value to their books, and I think that could give them a bit of a premium on their multiple. The other side of that is their tech platform, which is Galileo. Okay, now Galileo definitely isn't something that is taking up a ton of the share of the excitement right now with SoFi, but I do think if they get it right, it can contribute well because this is the goal. I think at least what SoFi is trying to do outside of being the everything app when it comes to finance, they are trying to take on a more high risk, high reward version of a bank, especially in terms of their stock, right? And so instead of just being priced like a bank, being valued like a bank, which can be very boring. I mean, what's the PE ratio on? Let's just pick one, like JP Morgan. Which I mean is actually performing decently recently. Yeah, I mean 15 to 14 range, depending on if you're looking at forward or current. 15 to 14. SoFi, on the other hand, is currently sitting between a 32 and a 20. Robinhood, which is a somewhat similar, is sitting between a 43 and a 35. They're trying to in some way be priced more like a Robinhood. And the way in which you do that is by getting the tech platform out there, getting revenue coming in from tech, getting revenue coming in from crypto, because that is going to allow them to have more of an expansion, more of a it's really volatile is the way to explain it. More of a volatile sort of price, volatile revenue, volatile net income and margins, and from these sorts of things. So similar to a tech stock, fintech, right? So not just finance, fintech. They're looking for those fintech valuations. So when it comes to Galileo, it landed at 84.5 million. So again, not really anything to be excited about quite yet. Which is about $500,000 on the line. I told you all in yesterday's live stream we were looking for 85 million. Came in at 84.5. It's really not a big difference there. Sequentially, that's a real bounce, which is up 12.5% from the 75 million, but it's still down 23% from the $109.8 million that it was just a year ago. Okay, just a year ago, and I think that's the reason why people are sleeping on Galileo. They're seeing it in a downtrend from last year to this year, and I think people are just scoffing at it. I don't think they should. I think that once the world is in a bit of a different environment, we could see the scale up to 130, 140 million. I think that is reasonable, but obviously there are tests that are just in the way. Now, in terms of accounts recovered to 134.8 million from 132 million, meaning that is climbing. But again, that is also well off from the $160 million peak from its Galileo accounts, which was at 160 million. So still down about 25 million or so from there. So you could call it a bottom forming, but it's definitely not a recovery quite yet. We're not saying Galileo recovering quite yet, but it is showing good signs, and I think that's all you're really looking for. Now, if you don't know what Galileo is, I'll just show you real quick. So Galileo is a cloud-native financial technology platform providing open AIs for digital banking, card issuing, and payment processing. So they're basically a part of the infrastructure that goes towards like this next wave of digital banking, neobanks, card issuing, all of these sorts of things. This is from about 2020. They acquired them for about 1.2 billion in cash, and it's a good investment, I would say. I mean, you 1.2 billion in cash, and obviously the net income's a little bit different, but we're still talking about $84 million in revenue. It's not bad. It's doing pretty damn decently. But I think there's better potential for it, especially as we move forward. SoFi's doing a great job at positioning themselves in front of the future. I still think that SoFi is a future play. I don't think SoFi is a present play. And yeah, I think this contributes to it. So I do like to see the fact that Galileo, although it is not recovering quite yet, it is uptrending over the last few quarters, and we are seeing it trying to overall maybe begin a bit of a recovery. Okay, now when it comes to guidance, that's all previous stuff. Let's talk about guidance. So they did raise top line, but that was it. Okay. So full year adjusted net revenue went up to 4.75 billion to 4.85 billion from 4.65 billion, which is good. They're raising. Their growth guide moves from 32 to 35% on top line gross revenue. But EBITDA bottom line stays at 1.6 billion. Net income stays at 825 million, with their earnings per share staying at an assumed 60 cents, which is a pretty, I think that would be a pretty big jump up. If you look at the last two quarters, we're not even at half of that. So they would be expecting things to really ramp up in 3 and 4. So what that means is that they are expecting to generate more revenue, but to generate basically the same profit, which implied that EBITDA margin actually eased from 34 to 33 to 34%. So it's one of those things where they're like, basically, we're going to make more money, but it's going to cost us the same. It's going to cost us that same ratio of money to make more money. So like they might spend an extra $50 million to make an extra $50 million essentially. So their net income realistically isn't expected to grow. So it's like not an amazing forward guidance. And I think this is something, it's a part of the reason as to why people don't like SoFi, they don't like fintech right now, is because you have so many of these other companies out there who are in the AI space and they're raising their guidance so much. I mean, you have some of these, whether it's hyperscalers, you have some of these chip companies, you have some of these software companies in the AI space as well, raising forward guidance. Boom, our net income's expected to grow, our net income's going to grow 30%, 20%, whatever. And then you have these sorts of companies like SoFi who are saying like, yeah, we're expecting to do about the same that we talked about before. It seems bad. Like the market's so emotional about AI right now, and it's so desensitized. That's realistically the best way to describe it. The market's so desensitized that it looks at these numbers and it goes, this isn't good, but it is good. This is still a very, very good year for SoFi. And I want you to understand, the world is not in a great place right now. Right? Whenever it comes to some of the financial services in which they offer, they're servicing clients who aren't in a great place. People don't have that much money. People don't have that much access to liquidity. People aren't investing as much. The crypto market's in a bear market. Like, this isn't a great time in general. And the fact that SoFi as a whole is still wading through this and building out the fundamentals of their company, generating what, $1.6 billion of EBITDA. That is insane. I mean, I think that's fantastic. And that's without all of the fire you can add to it, without Galileo, without crypto yet, without a lot of these things. I do personally believe I'm in the boat in which says, once we do see interest rates coming back down, I do think you're going to see, obviously they'll make less per loan origination or just per loan in general. Although they will make less because those rates are going to come down a bit, I just think more people are going to take rates. I think our loans out. I'm 100% confident in that, dude. I'm even someone who's looked at buying things. Me and my wife are actually going to be buying a home pretty soon. And when I ran the math, I was kind of like, it just makes more sense for me financially to invest right now, invest my money either into my business or into the market and let these rates come back down a little bit. Because once I ran, okay, these are my calculations for how much it would cost me per cash, upside potential and downside potential versus going purchase a home, it actually just made more sense to just wait. Now, that was because we moved. I owned my home and back in Louisiana, but I'm currently renting that out now. But now that I live in Texas, I was like, all right, I could buy now, or I could just rent for a little while and invest that capital that I would put towards, say, a down payment and closing fees and all that sort of stuff. The math made a lot more sense. And I'm very glad that I did that, because if you go look at my portfolios, I mean, my portfolios are up hundreds of thousands of dollars this year, or $100,000 $170 or something like that across most of them. And so to me, it made more sense. And I'm glad I did that because I've saved a lot of money. So I am someone who's like, I'm going to buy a house when things relax a little bit. I know the price of the house will go up, but the balance makes more sense to me that way, right? I'd rather just pay more for a house and less for the interest. And so I know a lot of people are going to be looking for that. And that's only for mortgages, right? I mean, they do so much outside of that. We can go look. I mean, whether it comes to student loans, which that's not really going to change too much, but home loans, personal loans, I mean, that's realistically only going to continue to grow into the future, especially the home sector. I think the home thing is really going to be what changes, but personal loans as well. One thing you have to understand is that the longer that we go with elevated prices and oil prices higher, the worse off people are going to be financially, and more people are going to need these personal loans to fund the things that they're looking for. But the good part is that although we are seeing more and more people borrowing, delinquencies are dropping. So it's like there's a good balance happening right now. And yeah, I think realistically, when people start to feel that spark of life again and they feel excited again, I think you're going to see that personal loan number climbing, folks. I think you're going to see grow. Then they have the small business loans and all that, 250,000, like, I think it's just all going to come together well. And so it's not particularly the most exciting company. It's not the one that's going to shock everyone. It's not the one that's going to make everyone feel real good and think that they're going to grow, blow past everyone's expectations. But it is the sort of company, in my opinion, that is being negatively impacted. And I think people are pulling it down for no reason. I think that people coming in and selling on these sorts of things, I just think it's a bit irrational. And it is the exact reason as to why I'm willing to buy SoFi in these sorts of moments. It's the exact reason why I am going to be deploying. My game plan is to watch SoFi very closely. If SoFi comes down into the green zone, which starts at $15.50 and ends at $14.67, I'm going to go in and I'm going to deploy. I'm not going to deploy quite yet because I am sitting just south of my average cost of $16.70. We're at $15.95. I'm looking for 15.50. So yeah, I'm going to go in and I'm going to deploy. I'm going to deploy here. So I'm down about 5% on the position. You guys know that I've basically swung on both ways in this position. My average cost is basically right here. My average cost is basically right here. Bam. Okay. Or no, a little higher. It's like right there. This is where my average cost is. If I get the opportunity to bring that average cost down into this green zone, guess what? I'm going to take it. If I get the opportunity to purchase SoFi at $14, at $13, at $10, I'm going to take it, you know? And yeah, we're just going to kind of go from there and see how it plays out. So I know that the market doesn't particularly like SoFi right now, and it's not excited about it. It's not interested in it. It doesn't think that these sorts of results are good enough to earn its investment. And hey, maybe that's true, right? Like a lot, maybe Wall Street, their perspective is, why would I buy something that's not scaling their expected income throughout the year, their guidance, when I could go buy stocks that are? That's actually not bad logic. I'm fine with that. I think that makes perfect sense, and I think it's totally reasonable. This does seem boring compared to all the other opportunities out there. My thought is, though, the risk versus reward is starting to become imbalanced in those other places. Because, yeah, you might have a Micron or whatever it may be that's scaling their net income and raising guidance week after week, year after year, month after month. But at what point does that peak? At what point does that slow down? Maybe not anytime soon, which is the reason why I don't think it's a bad buy. But I do think that there is more potential reward. You know, I see a SoFi climbing 80% from here easier than I see a Micron climbing 80% from here. That is true. I actually do believe that. I mean, SoFi climbing 80% from here puts it at, you know, $30. That's difficult, you know, but I do think that maybe could be a little bit easier with the current sentiment out there than Micron, you know, climbing up towards, and maybe not. Now that Micron's down at 800, maybe I don't believe that. Let me see. $1,500. I don't know, but you get the point, right? I think Micron climbing up here is going to be a much more risky ride than SoFi climbing up here. That's kind of the thought process that I have. Okay. And so that's why it's like, yeah, it might just take a little bit of time. And so for me, it's one of those situations where when I have a company that's value is growing fundamentally, so this is their value, but their price, I don't know why I just drew an R. Their price is doing this. This spread is where money is made. The spread between value and price that's driven down by emotion is where money is made. This is where money is made, in my opinion. And it might take a while. Don't get me wrong. It might take a while. But I am feeling pretty confident. I'm feeling really confident in SoFi here. And I do think that, look, there is a world in which it continues to break down. I've seen crazier things happen. You know, SoFi goes sideways here. Boom. It starts to capitulate down through these levels. Maybe it breaks, sweeps the low, recovers back up, sweeps the low, breaks out 2027, starts taking everybody for a ride and starts to rally up, you know, from there to the high, 100% gains there. And then it starts to say crush back up towards its top side golden zone, gets back up to it, comes back down, back tests it one more time, breaks above it, goes sideways, pushes it, boom, break, you know, like, I could see this sort of thing playing out here. You know, it could take that long. It could take longer than that. I'm just willing to ride that ride. I'm willing to go on this roller coaster ride. While everybody's chasing short-term gains in all these other places and taking a big risk on it, I'm willing to say, like, yeah, I think SoFi could do something like this. I think it's more, and maybe it takes more time than that. Literally, it could, you know, it could literally just do something like this. Right? It could. But I do think at some point you get that elevation. I do think at some point you get a SoFi pushing up to 30, $40. I think that is the case because of the way that they're capitalizing on the financial sector. I just think so. And so I'm willing to go in. And listen, I'm not a financial advisor. I'm literally a random dude with a black eye in a purple room at like 5 in the morning, 6 in the morning. Okay. Take this all with a grain of salt. But this is just my perspective. Okay. And so that's why I'm willing to go in. In a perfect world, if I can add another $10,000 or so to my SoFi position under $15, I'm going to. Because let's say, for example, I can build in my average cost, get my average cost down to say like $15, $14.50, and I have $18,000 in my SoFi position. And then SoFi gives me a run. You know, SoFi does end up giving me a run where it bounces. Say my average cost is from like $15.45. And SoFi gives us an elevation. Let's just do $15 flat. And SoFi gives us an elevation back up to $25, $24, right? On a 62% gain. A 62% gain on an $18,000 position is like a $10,000 gain or something like that. Yeah. Count me in. You don't think SoFi is coming back to this golden zone up here at some point? I am like 100% positive it will eventually. And obviously, again, that's my non-financial advisor opinion. I think it's going to. I do think it's going to. The question is, where is that golden zone, right? Because remember, if SoFi does take out these lows and comes back down to say $13 or 12.64, that golden zone drops. So it could be just 22 bucks. If it goes lower than that down to $10, it could then be 21 bucks. I think SoFi is going over 21, 22 bucks at some point. I just feel it. I just think so. I don't know how long it's going to take. That's the thing. Everybody wants gains right now. I'm willing to say it might not happen until the end of next year. I'm willing to wait because I'll make tens of thousands of dollars if it does. That's the thought process that I have, because SoFi is moving in the right direction. That's my point. Where is SoFi's fair value? I don't know. But what I do know is that its fair value is climbing. And as its fair value is climbing and its price is falling, eventually there will be a gap that will close. And that's where I plan on making some money, however long it takes. However long it takes. And so with SoFi, yeah. I probably buy a little bit today. I don't know how much cash I have left for July. I did deploy a decent amount of my cash into the portfolio this month, and then I deployed, of course, another 5,000 in free cash into the hyperscaler portfolio. So that was 10 grand, but I already had 5 grand from the other managed account. I don't know how much cash I have left for July, so I guess we'll see. I think I deployed 10 grand this month. I usually try to invest anywhere from 5,000 to 10,000 every single month because I am saving up for a down payment on a house. I'm putting like 5 to 10 grand aside for my down payment for my house, and I'm putting like 5 to 10 grand aside to invest every month. So it's like 10 to 20,000 a month, because my profit from my business that I personally pull on a monthly basis usually ranges around 20 to 25,000 in profit per month. And obviously I leave some in and whatever. So I don't know. I don't know how much cash I have available right now, but I'm going to go look, and then I might do a deployment sometime. And then if not, I'll just wait until August, and then August comes around and I just start investing again. So we'll kind of just go from there. I'm not in a big rush because we are sitting directly below my average cost. So it's like, we're not so far away from my average cost. And I'm like, oh my God, I need to get in. Like, we were at my average cost when it opened today. But yeah, we'll go from there. But we do have their earnings report, or their earnings call, coming in 10 minutes or so. So yeah, we will get into that when it comes. But overall, anything else I wanted to dive into? What you guys up to? How did you find the green buy zone? Yeah, you just go in and you just do it. Look, you can go in and just look for those lows. There's 2 ways you can do it. You can either just look for the lows and literally just draw a green box in to represent the buy zones, or you can use the toolkit. It is down below. You can use the toolkit. And what you do, if you go out to the weekly chart, and I'll just get rid of this for a second. Go to the weekly chart, turn on the toolkit, and turn on your buy zones or your hill zones, and it'll automatically show you where it is. It'll automatically show you where your hill zones are at right here. Yeah, you bet, bro. You bet. Oh, shout out to you, Don. You bet, Christopher. Good morning, everybody. Good morning. What's your breakfast today? I have not eaten breakfast yet. I literally had a nightmare of a morning. So like everything that could go wrong went wrong, and I was late for my stream by 15 minutes. That was the very first time I was late for a live stream, and I did not like how it made me feel. What's your business? I have 2. Well, I guess 3 now, if you include the stock channel. The stock channel is kind of becoming a business, which is pretty sick. So I have another YouTube channel. It's called Tyler Hill Crypto. So, and I obviously have sponsors and stuff for that business. That makes up a portion of my revenue. I guess I have 4. That makes a portion of my revenue. I have a management company, so it manages other creators in the finance niche. We have a couple dozen people that we work with. That does pretty decent as well. I have a little bit of real estate, nothing crazy. It doesn't cash flow a ton. I think I cash flow maybe $2,500 a month off my real estate, but I usually just leave it in because expenses pop up. That makes up a very small portion of my income. And now the stock channel is actually monetized. We have TH Capital. I make money from the ads that play on this channel. I have my toolkit, which you guys really seem to like. And yeah, so that's kind of all of it. It really ranges. I'm very transparent about these sorts of things. I don't care to share them. I don't really think there needs to be this weird stigma of sharing those sorts of things. Depending on the month, when we're in a bear market, I can usually do like 50 to 70,000 bucks in gross revenue on a monthly basis across everything. And then I usually have maybe like 15,000 in overhead, and then I live off another 10 or so. And then I have a couple other things in taxes, obviously. So it can range from like 15 to 25,000 a month in net that I'm bringing in, and then I invest basically all of it, usually. Or and when we're in a bull market and things start to scale, my creators are making more, my channels are making more. That can scale up to like 100 to 150 grand a month or so. But obviously, my overhead scales because I have to bring on more people to help me. But yeah, that's what we do. I don't care. Like, it's one of those things. I know some people don't share. I don't see a reason not to. It's like, I'm not flexing. I don't care if you think I don't. I don't care. It's not gonna. If you think it's a lot or not a lot, it doesn't really change my day. I just want to be transparent, because like when I'm making these sorts of portfolios, you need to understand I am backed by cash. I have cash coming in. I can hold for a long time because I have a balance. I'm floating every month. Even if my whole portfolio drops, I have cash coming in. I can build into the portfolio, right? I'm in a very, very different position than a lot of people are. And you need to take that into consideration when you watch my videos, right? But I do still show you how I take approaches. You're going to watch me build this hyperscaler portfolio from scratch, right? That sort of thing. But I can take more risks because my downside isn't as risky, right? But I still don't. That's the funniest part. Even though I can take risks, I don't because I don't want to lose the money I make. You know what I mean? I don't want to lose the money that I make. But yeah. What do you think? I didn't get a chance to look at it. You know why? Yesterday I was so this mouse broke, so I had to go get a new mouse. And when I went and get a new mouse, I also needed a new camera. So I went get a new camera. Then when I realized I needed a new camera, I also realized I needed a new phone. So I ended up getting a whole bunch of new shit yesterday. And by the way, I'm just yapping because the call starts in 5 minutes. I just didn't get a chance to look. And then my day went by. I went to training last. That was weird. Anyway, I took a knee to the eye, yada yada. So it was a little bit of it was just a whole thing. I also have no idea why my streaming software just cut off. But yeah, so I didn't get a chance to look at it, but I did want to look at it this morning when I got up and I had a chance. Appreciate you, G. Thanks for the transparency. Love the content. Yeah, no worries. I don't. I don't know, man. Dog, you're one of the people I trust most because of your transparency thing. You got it, dude. I'm not gonna freaking LARP, dude. There's so many LARPers on YouTube, and look, I'm not gonna lie to you guys. I've been. By the way, we are just waiting for the. I see a few of you just joined. We're waiting for the SoFi earnings call to start in 4 minutes. So I'm just yapping until then. I've worked with so many creators in this space, and they LARP, bro. Like, and hold on, let me make sure my stream is on. Can you guys hear me? Because I know it just shut me off for a second. Let's see. Making sure we're live still. It just like fully exited me out at some point. Yep, loud and clear. Okay, bet. Yeah, people LARP. If you don't know what LARPing is, it's live action role playing. It's like they're pretending. I actually know people who are pretending their portfolios are bigger than they are. And that is crazy. They also pretend like they make less money than they do so that their gains in their stock portfolios look better. Also crazy. Like they're just lying. They're literally lying. And I would never speak out again. There's no need to. It's not all chickens come to roost, right? But it's crazy. So that's why I'm like, you know what? I'll just tell you guys. I'll just be honest. There's no need to lie. And if you like it, you don't. Look, some people are going to hear how much income I bring in and think, oh, well, he's not one of us. Whatever, dude. Like kick rocks. I don't care. But yeah. Anywho. All right. Let's get into it. Earnings call should be starting up. I'm so excited to listen to this one, by the way. This is actually one of the earnings call I'm really excited about. I am 20. I just turned 25 years old. And yeah, I'll dive into that in a little bit when I get a chance. But this earning call is about to start. Basically, what I did is from 18 years old to 22 years old, I focused on income. I just focused on making money. That was what I focused on. I'm going to focus on making money. I'll worry about the investing stuff a little bit later on. I was investing, but I wasn't focused on it. Once my income scaled and I was capable of maintaining that income without needing to be working every single day, I then started focusing on my July 29th. There we go. I started focusing on my investments. Okay. Entire screen. Hey, can y'all hear that music? It should be like a slight music in the background. Let me know. Yep, you hear it? Okay. Cool. Oh, also, I'm working on a vlog. Hold on. I'm working on a vlog for my second channel. Everybody, if you want to say hello, feel free to say hello. We are up. It is 6:59 a.m. We got the SoFi earnings coming out. I'm on the live with all the homies. Shout out to everybody in there. Got Volcare, got Andrew. Good to see you all this morning. Jump Rope says, Tyler, since you're balling, loan $50. I want to go to the club. That is the sort of commitment I like, and I might just do that. If you're in TH Capital, I'll send you $50, and I actually mean it. All right. Got some good mornings coming in. Good morning from the homie Ken Chewy. Ken Chew, Eye in the Sky. All right. What's up, Will? Good to see you. What's comical about some creators is the public accounts. I know. Like, listen, I actually do keep some of my accounts private as well. It's a safety thing. Talk about that later.
Good morning. My name is Sarah, and I will be your conference operator today. At this time, I would like to welcome everyone to the SoFi Technologies second quarter 2026 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number one on your telephone keypad. If you would like to withdraw your question, press star followed by the number one again. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's second quarter 2026 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the second quarter of 2026 versus the second quarter of 2025. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. I'm pleased to share that we had nothing short of an exceptional quarter. Q2 was our 19th consecutive quarter exceeding the Rule of 40 with a score of 70. This included exceptional revenue growth of 40% year over year and a 30% EBITDA margin. Our team has continued to execute at a remarkable level, and our business mix has proven its durability, driving record growth and profitability in the face of a volatile interest rate environment. Few businesses have maintained such a strong combination of growth and returns for what has been nearly 5 years, and it still feels like we're just getting started. Our success is driven by our focus on building innovative products that are far superior to what is available from traditional banks and fintechs alike. Our members recognize this, and as their needs grow, they take out additional products and become our greatest advocates. This in turn fuels our growth and financial performance. Despite our significant scale, our growth has not slowed. We added a record 1.1 million new members in Q2, increasing total members 35% year over year to a total of 15.8 million members. To put this in context, we had 650,000 total members when I joined in 2018, and we are now adding that amount every 7 or 8 weeks. We also, for the first time, added twice as many products as members, despite having such rapid growth in members. We added a record 2.2 million new products in Q2, increasing total products by 42% year over year to 24.4 million products. This is a huge milestone for our Everything app strategy, as more members take out multiple products, driving our competitive advantage and having a superior lifetime value. In fact, we've reached an important inflection point with products per member accelerating over the last 2 quarters. We are starting to hit escape velocity on our path to be the winner that takes most in digital financial services. Cross-buy continues to accelerate with 51% of new products opened by existing SoFi members. This is up from 43% last quarter and 35% in Q2 of 2025. That's a year-over-year increase of 16 percentage points. This is a reflection of the trust members have in SoFi and the superior products we are building, which work better together and are designed to promote further cross-buy. 2 of the clearest examples of our unique ability to package all that we offer into uniquely differentiated products are SoFi Plus and SoFi Coach. Both are only possible because of our diverse set of products and services, and their usage drives cross-buying that powers our financial services productivity loop. SoFi Plus is our premium membership offering that brings the best of every SoFi product into one experience with a value that is unrivaled in the market. At the start of the second quarter, we relaunched SoFi Plus with significantly enhanced benefits in each of our products. For example, SoFi Money at 4.5% interest, and SoFi Invest with a 1% match, while fully transitioning the product to a paid subscription model. The results have exceeded our expectations. After just 1 quarter, we surpassed 200,000 paid subscribers, with most of the growth coming from existing members who are upgrading their memberships. This equates to an annualized revenue of over $24 million. Importantly, we're seeing incredibly strong cross-buy. 85% of new SoFi Plus members were existing members, and 25% of those are adding another product after Plus, with SoFi Invest accounting for the highest percentage of the follow-on demand. For new to SoFi members who join via SoFi Plus, SoFi Money is the main product that is subsequently being adopted. And across both groups, we're seeing very strong adoption of SoFi Relay and our lending products. SoFi Plus is doing exactly what we designed it to do. It's creating a recurring revenue stream. It's increasing awareness of the breadth of products in our Everything app. It's driving greater cross-buy, as well as increasing deposits, spending, and AUM in the existing open accounts, all in hand, increasing member lifetime value. It's the financial services productivity loop in action. We are encouraged to see the success so far, and I'd be disappointed if we are not at 1 million SoFi Plus members generating annual revenue of $120 million a year from now. That same strategic focus on deepening member relationships is behind SoFi Coach, which launched in June. SoFi Coach brings together 3 things no other company can: the full picture of a member's personal finances across their SoFi products and third-party products, the trust and security of a regulated bank, and soon, the ability to perform actions on behalf of our members. The result is personalized financial guidance across a member's entire financial life that helps them achieve the most critical success factor on their way to realizing their ambitions, which is spending less than they make and investing the rest. A key driver of Coach's success is our unique data set from both our breadth and depth of products, services, and activities. Coach is powered by SoFi Relay's hub of financial data that spans 12,000 connected financial institutions, 6.5 billion transactions, roughly $750 billion in outstanding balances, and over $250 billion in member real-world assets. This unique data set gives SoFi Coach an amazing level of insights on which to base its responses to members' financial questions and soon to be proactive insights to what members can do. Since Coach's rollout, we've already seen nearly 500,000 conversations with over 90% positive feedback. Every interaction with Coach gives us real-time insights into what matters most to our members, what they need, and where we can help them the most. For example, more than half of the conversations to date have focused on investing. We believe we can uniquely help the nearly 65% of Americans over the age of 18 that do not buy stocks, ETFs, or invest in robo accounts become great investors. This is just the beginning for Coach, and we'll continue to expand its capabilities. One of my favorite questions to ask is how much I've spent on subscriptions in the last month. Suffice it to say, I'm astonished by how many subscriptions I pay that I no longer need. I cannot wait for our launch of automated subscription management and cancellation coming later this year. SoFi Plus and Coach are exactly the kinds of products that make our model more powerful over time. They help members get their money right across their entire financial life. They deepen engagement across the platform, and they create more opportunities for cross-buy, resulting in more lifetime value that we can reinvest in better interest rates on checking and savings, better interest rates on tokenized deposits, higher matches on contributions to your invest account, lower interest rates on home loans, personal loans, and student loans, and better services like free certified financial planners. The durable and consistent 35% growth in our members and the inflection point in products per member and cross-buy that we've seen in the last 2 quarters are a direct result of these 2 everything products in our Everything app driving the financial services productivity loop, and we cannot be more excited about our strategy and execution coming together as we pull away from the industry. With that, let me now turn to the second quarter results. In Q2, adjusted net revenue was ahead of expectations and up 40% year over year to $1.2 billion. Importantly, our revenue growth continues to be durable and diversified. Total fee-based revenue was $472 million, representing 39% of total revenue in the quarter. This is an increase of 22% from last quarter and up roughly 38% year over year when normalizing SoFi Technology Solutions, or STS. The growth was driven by origination fees as well as strong performance from our loan platform business, interchange revenue, brokerage fee revenue, and SoFi Tech Solutions revenue. In the second quarter, we generated $1.2 billion in cash revenue. This was our 3rd consecutive quarter of generating over $1 billion in cash revenue. Our lending segment had another very strong quarter, generating a record $712 million in adjusted net revenue. In total, we had our best quarter ever for loan originations at $14.8 billion, which was up over $2.5 billion from just last quarter and included record originations across personal, student, and home loans. This was our first $10 billion quarter of personal loans. Of the $14.8 billion in total originations, $11.7 billion was for our lending segment and $3.1 billion was for our loan platform business. The diversification across channels demonstrates the strength and optionality that comes from having a fortress balance sheet and strong demand from our capital markets partners. Similar to Q1, we are balancing loans originated for our balance sheet with loan platform business originations to drive both returns and great visibility of net interest income for the next 6 to 8 quarters. Loans originated for our balance sheet are providing a competitive advantage in a large, durable, and highly visible revenue stream with attractive returns, which is allowing us to make massive investments relative to our digital competitors. For example, from Q1 2024 until Q2 2026, we have generated $5.4 billion in cash net interest income, which has allowed us to make significant investments to launch new businesses and drive high rates of growth in both members and products. Additionally, the net interest income recorded of $5.4 billion is 2.7 times the cumulative non-cash premium on our balance sheet of $2 billion. So not only is the scale of net interest income revenue an advantage, we are delivering significant returns compared to the original marks recorded in our non-cash revenue. Together, our financial services and technology platform segments generated revenue of $551 million, representing 46% of adjusted net revenue. Over time, we expect these revenue streams to be more than 50% of our revenue and a key driver of our long-term target return on tangible common equity of 20 to 30%, which is now becoming very visible. In addition to delivering durable growth, we delivered strong returns and profitability. In the second quarter, adjusted EBITDA was $358 million, up 44% year over year. Our adjusted EBITDA margin for the quarter was 30%. Our incremental EBITDA margin was 31% as we continue to balance reinvesting in the business to drive long-term growth and balancing profitability. Adjusted net income in the quarter was $160 million at a margin of 13%. Adjusted earnings per share were 12 cents, which included a negative impact of roughly half a penny due to higher than expected tax rate. Finally, our tangible book value ended the quarter at $9.5 billion, up 80% year over year, and $7.34 per share, which is up 56% year over year. Let me now turn to brand building and additional product innovations across our business. In the second quarter, unaided brand awareness rose to an all-time high of 10.4%, up 190 basis points year over year. It was another exciting quarter. We saw SoFi brand ambassador Wyndham Clark win the U.S. Open at Shinnecock. We brought together some of the biggest names in country music for CMA Fest presented by SoFi, reaching millions of viewers across ABC, Hulu, and YouTube. SoFi Stadium welcomed the world as host to Team USA in several FIFA World Cup knockout round matches, putting the SoFi brand on one of the biggest stages in global sports. And just yesterday, we announced a multi-year partnership with Notre Dame Athletics, becoming the first brand to appear on the Fighting Irish jerseys across all 26 varsity sports. In football, Notre Dame is in a class of one as the only Division I program with their own broadcast television media deal, giving them a national television audience for primetime games that is well above the average for 95% of primetime professional and college sports. Similar to the SoFi Stadium deal, SoFi will be seen by millions of unique television viewers each week. Turning now to our product innovation. 87% of our products, or 21.3 million total products, are now non-lending products. These include SoFi Money, SoFi Relay, SoFi Invest, SoFi Credit Card and Smart Card, SoFi Crypto, SoFi Protect, SoFi Plus, and recently launched SoFi Big Business Banking. These products are more broadly appealing, are used much more frequently, and have vastly lower customer acquisition costs than our lending products. And as such, put the sword in member acquisition that fuels our downstream loan originations via cross-buy at superior customer acquisition costs. The breadth and depth of our product ecosystem and the scale we've achieved with 21.3 million non-lending products that members engage with regularly will increasingly strengthen our competitive advantage and drive long-term growth in a way few financial services companies can match. Here are a few highlights. Our Invest products grew 38% year over year, while brokerage revenue increased nearly 2.5x. That reflects both growing engagement and stronger monetization. We know savings get you by, but investing gets you ahead. Savings alone won't get members to their financial goals. They also need to be investing for the long term. Yet 65% of Americans still don't invest. Our goal remains to make investing simpler and more accessible by giving everyday investors access to the best tools and opportunities which they have not historically had. For example, during the second quarter, we brought AI to SoFi Invest with the launch of Composer by SoFi. Composer lets members turn investing ideas written in plain terms into strategies they can build, test, and automate in minutes. It is simple, intuitive, and accessible, fitting perfectly into the SoFi Invest platform. In June, we also gave members access to the record-setting SpaceX IPO, which became the largest and most subscribed IPO offering in SoFi's history. It was our 36th IPO offering over the past 5 years. This year alone, we've completed more IPO offerings than in all of 2025, and we're excited about the pipeline of companies that may go public this year. Just this month, we launched SoFi Social 50 Income ETF, which gives investors exposure to an options-based income strategy without having to build and manage covered call positions on their own. This fund combines the 50 most widely held stocks across SoFi self-directed brokerage accounts with an actively managed option strategy seeking monthly income and long-term growth. Now let me spend a minute on SoFi Credit Card. We think we've cracked the code on efficiently acquiring high-quality credit card members. Year over year, credit card revenue has more than doubled. In fact, credit card revenue is up nearly 50% and products are up 17% from just last quarter. We're excited by the trends we are seeing, not only in the back book, which reached profitability, but also our ability to add the right members in this important product. Turning now to crypto and big business banking, where we're building the infrastructure to bring blockchain-based financial services to consumers and businesses alike. We have been pioneers in this space, becoming the first nationally licensed bank to launch crypto trading and our own stablecoin in SoFi USD. In the second quarter, we began settling our trading business in SoFi USD, and in big business banking, we began processing transactions on the SoFi Exchange network, enabling our first commercial clients to move money in real time 24/7. This marks an important milestone for two reasons. First, it creates more real-world commercial use cases for SoFi USD, helping to scale our new lower cost, faster and safer proprietary payment rails. And second, it significantly expands our enterprise offering for SoFi Technology Solutions, creating new opportunities for both fee-based revenue and net interest income over time. Big business banking clients can now hold funds in regulated insured business deposit accounts, move money and digital assets in real time through API-driven payments, and seamlessly convert between fiat and digital assets, all within SoFi's regulated banking environment. We first announced big business banking in January, and just months later, it's already in market and serving commercial clients. That speed of execution reflects both our culture and the capabilities of the SoFi Technology Solutions cloud-native banking core on which big business banking was built entirely. Big business banking isn't the only powerful proof point for SoFi Technology Solutions, or STS. We've begun onboarding SoFi Money to our new, modern, cloud-native banking core, fully developed by STS and purpose-built for U.S. regulated banking environments. The platform will soon be available to other banks, financial institutions, and brand partners. This marks the first major U.S. bank to join the platform, serving as a proof point for other large U.S. institutions who want to modernize their infrastructure to meet the demands of the evolving financial landscape. We're also accelerating SoFi Technology Solutions capabilities. During the quarter, we acquired Peach Finance, adding new platform services across credit card, lines of credit, buy now, pay later, and installment lending. The acquisition strengthens our offering for banks, credit unions, fintechs, and enterprise clients, while also positioning us to bring SoFi's own credit card processing in-house and launch a full-stack revolving credit card platform for our clients. Turning now to innovation with our lending products. Since 2024, we've been referring members to small business lenders through our online marketplace, but recently we identified an opportunity to serve these folks directly with a SoFi small business loan. Entrepreneurs and small business owners are the backbone of our economy, yet they are not well served. On one hand, you have banks and credit unions that are not providing the necessary access to capital or doing so at a snail's pace. And on the other hand, you have newer entrants that are charging exorbitant rates. Our new small business loan combines competitive pricing with the speed and simplicity members expect from SoFi, helping us serve more of our members' financial needs seamlessly on one digital platform. We are starting off by originating SMB loans through our loan platform business to establish partners. In the future, we may also create optionality to hold these loans on our balance sheet to generate recurring net interest income. In the second quarter, we also launched our new home equity line of credit experience, giving members fast access to a revolving line of credit right in the SoFi platform. Unlike most lenders, SoFi offers both home equity lines of credit and home equity loans, allowing us to match members with the right solution while providing a lower cost alternative to unsecured loans, and all with the speed and simplicity members expect from SoFi. Together, these products accounted for 1/3 of our record home loan originations during the quarter, helping drive growth as purchase and refinance remain muted in this high-rate environment. We had an amazing quarter on any measure. Our exceptional member and product growth continue to demonstrate the trust and confidence that our members have in the quality of our products that keeps them coming back for more. Our offering is unmatched across traditional banks, fintechs, and everyone in between. We continue to make significant investments in our platform, adding new products like SoFi Coach and making existing products like SoFi Plus even better. These investments reinforce what makes SoFi different, a seamless, integrated experience that helps our members do more with their money all in one place while advancing our mission to help people get their money right. Our execution has led us to an important inflection point in our strategy and results. As our member base grows, cross-buy increases, and engagement deepens, the power of our financial services productivity loop continues to compound. That flywheel is driving higher quality, more durable earnings, and positions us to achieve our long-term target of 20 to 30% returns on tangible common equity. We are building a financial services company with a business model that we believe is increasingly differentiated, increasingly profitable, and increasingly difficult to replicate. With that, I'll turn it over to Chris.
Thank you, Anthony. We had a strong second quarter and have great momentum heading into the back half of 2026. Our innovation and brand building continue to power exceptionally strong revenue growth. In the second quarter, adjusted net revenue grew 40% to $1.2 billion. Importantly, we generated $1.2 billion in cash revenue in Q2, our third straight quarter exceeding $1 billion of cash revenue. This included $790 million from net interest income and approximately $420 million from interchange fees, brokerage fees, technology platform fees, loan platform fees, and loan origination fees. Cash is defined and accounted for the same universally, no matter what type of company it applies to. In addition to our strong revenue growth, we delivered strong profitability during the quarter. Adjusted EBITDA was $358 million, up 44% year over year at a margin of 30%. Adjusted net income was $160 million at a margin of 13%. Net income was up 61% year over year. And adjusted earnings per share was 12 cents, which included a negative impact of roughly half a penny due to a higher than expected tax rate. This was our 11th consecutive profitable quarter. Turning now to our segment performance, starting with financial services. For the second quarter, financial services net revenue was $466 million, up 29% year over year. Contribution profit was $213 million, up 13% from last year. And contribution margin was 46%. Net interest income for this segment was $249 million, up 29% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 28% to $217 million for the quarter. During the quarter, we achieved record interchange fee revenue, which was up 67% year over year and 25% from just last quarter. This was driven by more than $28 billion in total annualized spend across money and credit card. We also achieved record brokerage fee revenue, which was up 2.4x year over year and 20% from just last quarter. During the second quarter, our loan platform business generated $143 million of revenue, driven by the $3.1 billion of personal loans originated on behalf of third parties, as well as referrals. This includes $2 million of servicing income recognized in our lending segment. Our loan platform business helped us achieve another quarterly record in total personal loan originations of $10.7 billion, meeting incremental demand from our members beyond what we would put on our balance sheet. Note that during the second quarter, we had significant demand from LPB partners over and above what we decided to fulfill, but we did fill all demand from our contractual commitments and more. We have also recently made several positive advancements with our loan platform business. First, we've reached an agreement with a new partner, Sixth Street, to invest in personal loans totaling up to $1 billion. Second, we've expanded our offering to include our new SMB loan product and have agreed to terms on a 3-year, $3 billion agreement with Base Point Capital. Third, we've just further expanded our offering to include our home equity loans, with the first loans being transferred in the coming days to a leading global bank. Adding 2 new loan types to the loan platform business is a significant achievement that will not only provide opportunities to grow our capital-light fee-based revenue, but it will also allow us to serve more members, generating more cross-buy over the long term. LPB is a great example of how we can build highly scalable, tech-driven platform businesses. Shifting to our tech platform segment. For the second quarter, we delivered net revenue of $85 million, up 13% from the prior quarter. Contribution profit was $12 million at a contribution margin of 14%. Revenue growth was driven by further monetization of existing clients, as well as contributions from new clients. Turning to our lending segment performance, which was very strong during the quarter. For Q2, adjusted net revenue for the segment was $712 million, up 59% from the same period last year. Contribution profit was $399 million, with a 55% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 54% year over year to $573 million. The balance of the growth came primarily from loan origination fees, which were up 64% year over year. During the quarter, we saw continued record member demand for our lending products. For personal loans, we delivered record originations of $10.7 billion, of which $7.6 billion was originated for our balance sheet. The ability to hold loans on our balance sheet is a key differentiator for SoFi, allowing us to generate predictable, recurring net interest income and to efficiently deploy our capital to generate strong risk-adjusted returns. For example, our core personal loan product generated a roughly 6.1% risk-adjusted margin in Q2. This consisted of a weighted average coupon of 12.9%, a funding cost of 3.1%, and annualized losses of 3.7%. Our ability to generate loans with attractive risk and return profiles supports our strong revenue growth through both balance sheet lending and our loan platform business. In addition to the record personal loan originations, we also saw record originations in student and home loans. Student loan originations were $2.7 billion, up 2.7x from the same period last year. Home loan originations were $1.4 billion, up 74% from the prior year. Turning to capital markets, where activity continued to be strong in the second quarter. During the quarter, we transferred $3.1 billion of personal loans through our loan platform business. We also closed $834 million in home loan sales at a blended execution of 101.6%. Consistent with prior quarters, we sold $90 million of late-stage delinquent personal loans. In addition to these loan sales, we executed 2 securitizations of loans originated on behalf of our partners through the loan platform business, totaling $1.37 billion. These transactions priced at an industry-leading cost of funds levels with weighted average spreads of 91 basis points and 86 basis points, respectively. In fact, 86 basis points was our best ever pricing, reflecting exceptional demand for SoFi-originated loans. I would also note that our most recent deal was meaningfully upsized from the original deal size. Turning to credit performance. Our credit performance remains very strong overall, performing in line with our expectations and driving attractive returns across all loan types. For personal loans, we saw a very strong credit performance during the quarter. Excluding the impact of delinquent loan sales, the estimated all-in annualized net charge-off rate was 3.7%. This 70 basis point decrease from last quarter was driven by an improvement in the underlying credit performance as well as growth in average loans on the balance sheet. Including the impact from the DQ sales, the net charge-off rate was 2.62%. This is down 41 basis points from the first quarter and 21 basis points from the second quarter of 2025. The on-balance sheet 90-day delinquency rate was 40 basis points, down 7 basis points from last quarter. For student loans, the annualized charge-off rate was 61 basis points, down 4 basis points from the prior quarter. The on-balance sheet 90-day delinquency rate was just 11 basis points, up 1 basis point from the prior quarter. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which is done alongside an independent valuation specialist. This is based on actual loan level data and considers a number of factors, including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the second quarter, our personal loans were marked at 104.7%, down 71 basis points from the prior quarter. This was driven by an increase in the discount rate, which was up due to higher benchmark rates, as well as a modest increase in the default rate and prepayment rate assumptions, and a small decrease in WAC. At the end of the second quarter, our student loans were marked at 104.4%, down 85 basis points from the prior quarter. This was driven by an increase in the discount rate due to a higher benchmark rate, partially offset by a modest decrease in the prepayment rate. The WAC and default rate assumptions remained relatively consistent with the first quarter. Turning to our balance sheet. In the second quarter, total assets grew by $7.2 billion. This was driven primarily by $5.8 billion of loan growth and roughly $800 million of growth in cash, cash equivalents, and investment securities. Total company-wide cash at quarter end was $3.6 billion. On the liability side, total deposits grew by $5.3 billion to $45.5 billion, which included strong growth in member deposits. Our net interest margin was 5.98% for the quarter, up 4 basis points sequentially. This included a 7 basis point increase in average asset yields, partially offset by a 1 basis point increase in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 18.8% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Over the medium term, we expect to efficiently deploy our excess capital into high-returning assets while letting our risk-based capital ratio normalize toward the low to mid-teens. Tangible book value grew $4.2 billion year over year to $9.5 billion. The tangible book value per share at quarter end is $7.34, up from $4.72 a year ago, a 56% increase. Let me finish by providing our outlook for the year and some longer-term thoughts. In line with market expectations, we now expect an interest rate outlook consistent with the Fed funds futures and 1 to 2 hikes in 2026 versus the expectation of 2 rate cuts when we first provided our 2026 guidance. Now for our specific guidance. For the full year 2026, we now expect to deliver adjusted net revenue of $4.75 to $4.85 billion, which equates to year-over-year growth of approximately 32 to 35%. This is up from our prior guidance of approximately 30% year-over-year growth. We continue to expect to deliver adjusted EBITDA of approximately $1.6 billion, which equates to an adjusted EBITDA margin of approximately 33 to 34%. Adjusted net income of approximately $825 million, which equates to a net income margin of approximately 17%. And the EPS of approximately 60 cents. Our EPS guidance now includes a tax rate of 22%, which is approximately 700 basis points higher than our original guidance. At the same mid-teens tax rate as our original guidance, our new guidance today would have actually been 65 cents in EPS instead of our actual guidance of 60 cents in EPS. As we look out over the longer term, we are on a path to generating returns on tangible common equity in the 20 to 30% range. ROTCE is the product of net income margin times the amount of revenue generated per dollar of tangible equity. For example, a 25 to 30% net income margin combined with approximately $1 of annual revenue for every dollar of tangible common equity produces roughly a 25 to 30% ROTCE. Achieving both a net income margin of 25 to 30% and the revenue of equity ratio of 1 is embedded in our strategy with a very visible path from where we operate today. First, we expect continued expansion in the net income margins due to both higher margin businesses becoming a larger part of our mix, and we continue to realize operating leverage. Second, we're increasingly generating more revenue without a commensurate increase in equity by growing more capital-light, fee-based businesses. We have high visibility and confidence in our target net income margin because our incremental net income margin has already been approximately 30% while growing revenue more than 35%, demonstrating that these margin levels are achievable. As the business matures and incremental margins increasingly become overall margins, we believe the path to a 25 to 30% net income margin is highly probable. Revenue to equity is a function of revenue mix and capital efficiency. We believe both of those outcomes are achievable over time through execution of the strategy we're already pursuing, which is why we have confidence in our long-term return profile. Overall, Q2 was a strong quarter, and we continue to have strong momentum in our business. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. Please keep in mind we'll take only one question per person at a time. Please rejoin the queue for any additional questions. Thank you. Your first question comes from Devin Ryan with Citizens Bank. Your line is open.
Thanks. Good morning, Anthony and Chris. And first off, congratulations on the Notre Dame partnership, my alma mater. So good to see that yesterday. You got a lot of attention. Question just on loan platform, and really want to focus on some of the new capabilities with SMB and home equity and the new agreements that you guys have recently announced. Can you just give a little bit of context around the capacity that you see in kind of some of these newer categories, and also how quickly SoFi can build origination volume into that capacity, and just also how we should think about kind of the fee economics in these new categories as you kind of expand beyond personal loans? Thanks.
Yep, absolutely. Thanks, Devin. So in terms of loan platform business, that was originally started a few years ago, primarily as a referral channel where we were sending all of our declines to a marketplace and generating a fee. That evolved over time to where we started to originate on behalf of others in meaningful scale from an unsecured personal loan perspective. I would say, and I've said this consistently, the nirvana state for the LPB business is to be able to go to investors with a menu of options and asset types that allows them to pick and choose exactly what they would like from both the risk and reward and return profile perspective. And one of the key things that we needed to achieve was to start expanding loan platform business into other asset types. And this is the first quarter where we were able to do so by introducing the SMB partnerships. There are 2 of them. One is with Base Point Capital for $3 billion over 3 years, and the other is with an undisclosed party for several $100 million. And then we are also introducing home equity lines of credit to the mix as well in the coming days. In terms of the overall size and scale and opportunity and our ability to originate into that, we're just starting to originate in meaningful scale on the SMB side. There's considerable demand from an application start perspective, and you would expect to see economics in the range of where we're executing today to maybe slightly better. On the closed-end seconds and mortgage side, similar story. We're already originating at a pretty good clip right now on a monthly basis, and the partnerships that we're talking about are in the $100 to $200 million per month, but we're talking to several parties. But we certainly have the ability to originate into that. And again, from an economics perspective, we don't disclose that by party, but you could expect it to be similar to where we're executing today.
And the other thing I would add is that as we continue to build out a more diversified portfolio of loan platform businesses, we build new relationships that can benefit existing loan platform businesses. The SMB business is one that we think we can be incredibly competitive on. Similar to personal loans and credit cards, most SMB lenders are charging exorbitant rates of over 30%. We think we can operate meaningfully below that and take significant market share. If you think about our portfolio of loans and originations more broadly, we are really taking massive market share from high return, high profit margin types of products. So in personal loans, we're underwriting WAC at about 12% compared to credit card at 25%. That's an incredibly compelling value proposition for any individual consumer. In SMB, as I mentioned, we could be 10 or points below where the pricing is on SMB. Closed end, also, we can be more competitive than others. And because we're more competitive on price, we get higher quality borrowers, which will only reinforce the productivity loop of originating high quality borrowers, delivering great return assets to our partners, putting great return assets on our balance sheet, driving capital that can continue to fund that. And we're very close to that whole equation playing out.
Your next question comes from Andrew Jeffrey with William Blair. Your line is open.
Thank you. Good morning. Great to see the momentum you have in the business. Anthony, kind of a high-level question for you. I know the company has been sort of hyper-focused on driving members given the size of the TAM, and now it seems that cross-buys reached a pretty important inflection point. Is this the time to sort of focus on monetization sort of at the margin versus member growth, or do you think you walk and chew gum and we see both metrics rise over the next couple of years?
It's an important point that you bring up. It was an important inflection point for us in this quarter. It started in Q1. We didn't want to overemphasize in Q1 relative to Q2, but make no mistake about it. This is the first half of this year has proven that our broad-based everything app strategy is working. We've seen improvement in products per member in Q1 and Q2. We continue to expect that to happen for the foreseeable future. We have the right portfolio of products where people are organically acquiring the next product. And so if you think about Relay and you think about SoFi Money, those are tip of the sword products that are broadly appealing. We have over 7 million Money members now, over 6 million Relay members. The more Money members we bring in, the more Relay members we bring in, the more downstream benefit we get in SoFi Invest and SoFi Credit Card and SoFi SMB, as well as all the loan products. And those acquisition costs are basically zero on those other products, which basically doubles the profitability on the loan side. And so there's a great flywheel here at work. And what's changed this year is that the SoFi Plus product, the SoFi Crypto product, are absolutely driving product per member organically. So as we mentioned in the remarks, SoFi Plus relaunched. We're already at over 200,000 paying members, which is on a run rate basis going to be over $24 million a year, and it's growing very rapidly. But the most important thing is that 85% of those new SoFi Plus members are existing members. And a quarter of them are taking out another product after they take out SoFi Plus. So if an existing member takes out SoFi Plus, they have at least 2 products since they're existing, and then 25% of them are taking out another product. Layer on top of that, more broadly appealing products like crypto and more broadly appealing products like SMB and now big business banking, and you can see the flywheel really working. So our growth is going to be driven by members, by products per member, and by revenue per product. So all three working for us, and you saw that in the quarter.
Your next question comes from John Hecht with Jefferies. Your line is open.
Hey guys, good quarter. Thanks very much for taking the question. Anthony, I'm wondering if maybe you can give us an update on the competitive, the competitive environment and like customer acquisition costs and channels, and how are those trends going?
Yeah, outside the loan business, the competition is very benign. Our customer acquisition costs are staying pretty stable. The team's doing a great job of really optimizing unit economics and driving efficient scale in customers. The fact that we're driving 35% year-over-year growth in members and over 40% growth in products and really keeping CAC constant is a function of the great data analytics we have and the value prop that we have. Each one of our products, we absolutely designed to be the best of breed on its own, both from a value prop to the consumer as well as a unit economics. So we're indifferent in what product they take first. But we're seeing continued strong demand in our channels at stable pricing in all of the financial services products. The lending products are definitely more competitive, but we have very unique products. So in personal loans, we're really not competing with big banks. They don't offer personal loans primarily because they have these huge credit card businesses that they don't want to cannibalize. So we're kind of competing with the smaller companies that don't have as much capital and they have higher cost of funding than us. So we've competed really well. But don't get me wrong, like I'm focused on funnels and pricing every day in the PL business. The student loan business doesn't really have a competitor in the home loan business. So overall, pretty benign environment at the top of the funnel. Bottom of the funnel, nothing's changed, but it's always been competitive on pricing. And we're pretty nimble and have a significant advantage in lower funding costs than others. Not to mention a large percentage of home loans are cross-bought from existing members,
and increasingly a higher percentage of personal loans is cross-bought again without customer acquisition costs.
Your next question comes from Dan Dolev with Mizuho. Your line is open.
Hey guys, really nice results. Congrats. Just wanted to ask, maybe Chris, can you walk us through the rationale of not raising the EBITDA? Obviously, results are super strong. Just some color on that. I think a lot of investors are.
Okay. Let's see.
Lean into them. And that's what we're doing today. There are just too many large, attractive growth areas for us to invest versus adding even more profitability. The profitability opportunity is not going to go away, but choosing not to invest today would come at the expense of capturing that growth opportunity in the future. The incremental revenue gives us obviously the additional flexibility to invest in initiatives that we believe will drive long-term growth while maintaining the EBITDA and EPS guidance that we've provided.
Dan, the other thing I'd say is we don't want to over-optimize for the actual EPS that we hit or the actual EBITDA that we hit relative to these bigger growth opportunities, but we also do need to be balanced relative to the environment. And while we couldn't be more positive about the demand for our products, the performance that we're driving with them, the credit trends we're seeing, the spending trends we're seeing, as well as the investing trends, all of those things are green and up and to the right. And so that's what's allowing us to drive such strong demand. It's not coming at higher costs, which I think is what a lot of people will point to. The incremental investment is on new growth opportunities. This year, we've launched a number of things that were never in our 2026 plan. We just launched big business banking. We launched SMB. We launched SoFi USD. We launched SoFi Crypto. And we're leaning into SoFi Plus because of how well it's doing. So that momentum is absolutely continuing. The other thing I would just say is we entered the year expecting rate cuts. We're now expecting 2 rate increases. We've not only maintained our guidance for revenue and profitability, we've exceeded expectations on the revenue side. So when we think about the back half of the year, I don't know if there's going to be 2 rate cuts. If they are, we're going to be fine. 2 rate increases. If there are, we're going to be fine. If there are no rate increases, we probably have upside to the bottom line. But we have the cushion in our guidance to be prepared to deliver in regardless of the environment.
Your next question comes from Kyle Peterson with Needham. Your line is open.
Great. Good morning. Thank you guys for taking the question. Wanted to talk on the loan platform business. I think this is the second quarter in a row you guys have talked about the demand is really good from the buyers, but you guys aren't necessarily fulfilling some of the upsized requests based on like capital levels and unit economics for you guys. So I guess how should we think about, should that continue on the personal loan side moving forward as you guys still have really strong capital ratios? And I guess like is any of that volume decision impacted by HELOCs and SMB starting to get ramped up on the platform? Thank you.
Yep. Yeah, absolutely. Thanks, Al. So I'd say on how we're feeling about the PL business as it relates to LPB, we're happy with that level of volume. We're able to meet all of our contractual commitments and then some. And where you're going to start to see more meaningful growth is in some of these other asset types. And I walked through those earlier in the call during my prepared remarks and in the first question. As it relates to some of the capital consumption questions and how that pertains to LPB, what I would say is that we're self-funded through our guidance period and the medium-term operating plan that we've laid out. As our profitability continues to improve, our organic capital generation is going to continue to increase as well. Combined with continued growth in our capital-light businesses that Anthony's mentioned, as well as the flexibility that we have in how we monetize our originations, whether that's through the LPB program or on the balance sheet, we believe that we can operate comfortably within our target capital range without the need to raise capital under our current operating plan.
Your next question comes from Pete Christensen with Citi. Your line is open.
Thank you. Good morning. Really nice results here. Anthony, I'm curious, with introducing some of these more commercial like products, how should we think about the cross-buy flywheel here, or I guess in the future, and putting it around some of these newer offerings? Is it, hey, there's a small business, we could connect to some of the proprietors there, maybe for personal banking, or do you envision some additional services that could serve that market to increase cross-buy?
Yeah, what I'd say is the following. The most common sort of path or stage someone goes through is they come in through SoFi Relay or SoFi Money. They come through Relay, the most prominent next product is going to be SoFi Money. If they come in through SoFi Money, there's going to be a path to Relay or to SoFi Invest or to loans. SMB really was born out of the fact that a large percentage of our members actually are small business operators. And back during COVID, when the government provided PPP loans, we got a significant amount of demand for applications on PPP loans, even though we were not in the SMB business. We actually stood up an application process that met the government's application criteria and helped pass on that demand to lenders. And then on the back of that, we built a marketplace so that we actually get paid for that referral process that we're doing. So the SMB business is very much synergistic to the rest of our business. And I would think of it as just another use case for an individual to satisfy the needs they have from a borrowing standpoint. We'll obviously follow this up with checking and savings in SMB and other products that are ancillary to that. And so it will add to the flywheel. Big business banking, I don't think is truly appreciated by people outside the company. We were looking to partner with marketplaces and market makers in crypto, and everyone we talked to said, can you please be our actual bank? Can you build a fiat and crypto banking capability that's API driven? And that's where that business was born out of. And so not only will it be a business on its own, it'll drive second order benefits in driving more usage of SoFi USD. And the SoFi USD product is going to be driven obviously by the net interest income from leaving that cash at the Fed bank and earning Fed funds on it. And so we have a number of pieces of demand for SoFi USD. We have big business banking, which is now up and running, and people can use SoFi USD as a form of payment in those payment rails. We have our crypto business, which is actually settling in SoFi USD. On the consumer side, we have our debit and credit card with MasterCard. We'll begin settling in SoFi USD with MasterCard in the coming weeks. And so these businesses are starting to layer on top of each other, and there's synergies across them.
Your next question comes from Will Nance with Goldman Sachs. Your line is open.
Hey guys, thanks for taking the question. I wanted to ask a question on the SoFi Plus commentary that you had and some of the membership growth that you guys have seen. I was hoping you could maybe talk through just the profile of the customers that are adopting the product. You know, what have you seen from a wallet share perspective or an engagement perspective? Have you seen things like average deposit balances increasing or engagement with the SoFi platform increasing on the back of some of those signups? Thanks.
Yeah, our hope when we relaunched SoFi Plus is that it would increase the awareness of the other products that we offered that existing members may not be aware of or new members may not be aware of, because SoFi Plus is meant to be the best of every individual product. So if you sign up for SoFi Plus compared to just SoFi Money, you get a higher interest rate, you get other bells and whistles. If you sign up for SoFi Plus compared to just SoFi Invest, you get a 1% match. And each product, credit card, better rewards, et cetera. So of the 206,000 SoFi Plus members that we reported in the quarter, 85% of them are existing members. And so it's the same demographic of our member base already because they are members. And the 25% incremental purchases of a new product after SoFi Plus, it's primarily the thing that's benefiting the most is Invest. And that's really encouraging. That means we're increasing share of wallet. We have investors for the first time that are novice and new investors, but we're also getting investors that are transferring their money because of the match. Secondarily, the SoFi Money product is the product that benefits if SoFi Plus is in that 15% bucket. So SoFi Plus is the first product of a member. The second product that they're buying is SoFi Money. In terms of the actual second order effects of their existing activity, a SoFi Money member that takes out SoFi Plus, 1/4 of them are taking out a third product. but we're actually seeing increases in their deposits on the back of that SoFi Plus subscription sign up, and we're seeing increases in AUM as well, and we're seeing increases in spending. So there is a benefit for more products being taken out from SoFi Plus, and there's a benefit for more engagement as defined by more deposits, more AUM, and more spending. Here's a really interesting data point. I looked back at the Q1 2021 cohort. Of the money members in the Q1 2021 cohort that became money members that quarter, with the launch of SoFi Plus, we increased the product per member of that cohort by one product in the quarter, which is, if you think about it, that's almost 5 years old, that customer that was acquired, and they added one product for the entire cohort in the quarter. So it's having a really strong impact, and that's why we mentioned in the earnings results and in my comments that we're seeing an inflection point benefiting from the flywheel. Crypto is also contributing to that flywheel as well as a new product.
Your last question will come from Matt Code with Truist. Your line is open.
Hey, good morning, guys. Thanks for taking the question. Anthony, I just wanted to ask about the spend down of that excess capital that you guys have talked about. So you're in that advantageous position where you have a really strong CET1 ratio, a lot of capital to spend, but you brought down that CET1 ratio pretty quickly over the past couple quarters. So could you talk about just capital balance sheet growth and kind of the spend down and the pace of the spend down of that excess capital?
Sure. I'll let Chris get into the numbers in more detail. One of the benefits of growing our balance sheet in Q1 and Q2 of this year is that we have very strong visibility into our revenue for 2027. And that visibility is going to continue because if we maintain our balance sheet at this size, it's going to produce the net interest income that's being delivered today consistently over time. Barring a huge change in the economy or overall credit performance, we can kind of count on that revenue in the future. And that's a really stable thing to have, so we can, at a minimum, fund a significant amount of investments regardless of the environment that we're in. And so when people ask, like, why are you putting loans in the balance sheet? Why are you not doing everything through loan platform business? It's because we want to make sure we have revenue in the future that's visible, that can deliver no matter what, and it's 100% in our control. We layer a loan platform business on top of that, not just in PL, but now SMD and closed-end seconds. And it's a very incremental additive return on top of something that's very visible. And we have 5 years of history. I don't know if people heard the numbers that I mentioned about over $5 billion of cash net interest income from what we generated in Q1 of 2024 through Q2 of 26. But that's an astronomical number, especially where it's 2x greater than what the non-cash revenue was recorded as a premium over time, which shows that the loans are really performing. I'll let Chris talk about where the capital ratios will settle out, et cetera.
Yep. So we exited the quarter at an 18.8% total risk-based capital ratio, which is our binding constraint. That's well above the regulatory limit of 10.5%. As I mentioned in my prepared remarks, we believe that having a risk-based capital ratio in the low to mid-teens is appropriate for this business longer term. And like I said a few minutes ago, based on our current operating plan and the guidance that we've provided, we feel really good about being able to operate within those confines without the need to raise capital. As you know, as we continue to expand profitability, our organic capital generation will continue to increase. And by continuing to scale our capital-light fee-based revenue streams, that will help as well.
At this time,
Operator, I'd like to end with some closing comments. In closing, Q2 marks a clear inflection point in our strategy, where our Everything app is driving higher products per member, resulting in higher lifetime value, supporting superior levels of investment, and our ability to offer more value to our members than anyone else in better rates, products, and services. This continuous reinforcing cycle of the financial services productivity fuels durable growth and high returns. The benefits of this strategy, in our view, are no longer theoretical or a leap of faith. They are 100% in our control via disciplined execution. I'm often asked why I buy the stock, and the answer is simple. I believe we will achieve the returns that Chris walked through before of 20 to 30% return on tangible common equity, and it's just a matter of when, not if, the market can connect the dots to the attractive return potential of our business. Until then, we're going to keep our heads down and continue to execute and deliver for our members and our shareholders. Thank you, and we look forward to talking to you next quarter.
Goodbye. This concludes today's conference call. You may now.
Yo, that goodbye at the end was crazy. Did y'all hear that? I should say goodbye. Okay. What's up, folks? Dude, it's always so weird. Am I good? Yeah. It's always so weird how like I'm so quiet for so long that whenever it ends, I feel weird talking. But man, what a good call, dude. What a good call. What good earnings. I think Anthony laid it out perfectly. Just now, he said, we can clearly see a path to 20 to 30% returns on tangible common equity. And once the market recognizes it, and we're just waiting for the market to recognize it and connect the dots. Until then, they will continue to, and I think he said something along the lines of like, I don't know, perform for their shareholders or something along those lines. Wow. Good. I mean, so just to give you a recap, I know some of you are new, some of you just came in, so welcome in. We've been live since like 6. Kind of like when they do earnings. Kind of like when they do earnings really early, but then I also kind of hate it because at like 3 p.m. I get tired. And today I can't get tired at 3 p.m. because we have Microsoft and Meta later, the two M's, and the FOMC. So I'm going to be live for all of that. But all in all, let me kind of give you a bit of a recap on everything. So today we got some very, very good earnings from SoFi. Adjusted earnings per share came in at 12 cents. Expected was 11 cents. Adjusted revenue came in at 1.21 billion, a record-setting quarter for them, with analysts expecting it to be at 1.11 billion, beating expectations by 8%. Revenue growth, that then, of course, puts revenue growth at 40%, being great because their expected revenue growth year over year was 30%. Adjusted EBITDA was 358 million, topping the 330 million expectations by about $28 million, with their members climbing up to around 15.8 million, which is, of course, 1.12 million over the record. Net income came in at 156 million, so basically in line. This is what the market was expecting, and it does just go to show that the current environment that we're in right now is maybe putting a little bit of constraint on their margins, but they've clearly laid out a path to generating better margins, and I'll talk about that in a second here. Now, all in all, they did release a couple good things. I want to read off from my notes here a couple things that I thought were important. First and foremost, when it comes to the crypto side, you guys know I care a lot about the crypto side of SoFi. They are continuing to build out their crypto infrastructure, and within the last 6 months, they've now gone and allowed their institutional clients to be able to, of course, transfer assets between fiat and digital assets seamlessly 24 hours a day, which is fantastic, and that is going to be great considering they have SoFi USD. Their stablecoin, and they are one of the, if not the only nationally chartered bank allowing for this sort of thing, which is fantastic. Another thing that they're doing that I'm a big fan of is they are building in more subscription revenue. They are releasing certain things, SoFi Plus, etc., which will obviously generate higher accounts and higher product usage per customer. Speaking of product usage per customer, it definitely seems as if their focus recently has been just increasing the amount of products that people have access to through their just through the platform itself, which is fantastic because you got to think about it, right? If you look at every one of the products that they offer as an individual business, if somebody goes and signs up for this one business, this one service that SoFi offers, and then because they're using that one service, they then go use another service, the CAC of that second service that they then progress to is nothing. There's no cost to acquire that customer because it's coming organically from another one of their businesses. And as that CAC reduces or goes to zero across those further progressive services, what that does is brings their CAC in general, cost to acquire a customer, down as a whole, which of course increases their profit margin. So every time they spend money to go acquire one customer and it seems like their CAC isn't growing or dropping, staying stable, they're increasing the amount of revenue they're generating per customer at no additional cost. And he did say that that's of course growing very organically right now. And they are seeing customers going from one service to the next, which means that them becoming the everything app, which is what their goal is like, how do I explain it? That's what they're trying to do, and that's what they're accomplishing, which is the reason why they are very, very seemingly adamant, very, very adamant that their ROTCE, which is return on tangible common equity, could reach anywhere from 20 to 30%. And the market just doesn't seem to realize it. Everybody looks at what they're doing right now and thinks it's boring, but they see a very visible and clear probable path to 20 to 30% returns on tangible common equity, which is fantastic if you're a shareholder. And I think that's the sort of thing that's going to cancel out the dilution argument, right? Everybody's worried that they're diluting, and that is a problem, right? They definitely do dilute a good bit. But at the end of the day, if you go look at previous fintech companies or tech companies in general, they also dilute. The thing is, they dilute up into a point in which their margins are so sustainable and are at such a great margin that the dilution gets canceled out, but then it's still a net positive. These sorts of dilutions in a way can lead them to being more profitable. And it seems as if they are understanding of that. And that's why they're trying to drive their margins down. And it seems like they're doing a very, very good job at this because they're consistently building in these light, non-capital intensive businesses that they're launching like freaking boom, 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 just constantly launching new services and products that people can use, whether it be the Trump accounts, whether it be small business loans, whether it be SoFi Plus, whether it's SoFi Money, it doesn't matter, right? People are signing up by the millions. And one thing that he mentioned that I don't hear a lot of these companies talk about these days is they are still doing brand building. They're still doing brand building. They're going out there and they're sponsoring these events. They're getting their name known. And I know a lot of people look at that and they don't think it's important. Guys, it is important because what that does is it increases the accounts and it increases the usage, which is the exact reason as to why their revenue, which was previously dominated by vast majority by just their loans and their lending business, is now seeing a bit of a balance between some of the other services that they offer. And once SoFi really does get a good grip on the revenue being generated by these non-loan businesses, it's going to be able to be priced at a different multiple than a traditional bank, which is why I think it calls for a higher premium. The only reason SoFi's price is down right now was one, it went too far too fast. It was priced too high. It didn't deserve a $30 share price at the time. And that is the exact reason I didn't buy it at $30. Truth be told, I didn't look into SoFi stock until it was at $24. It was at $24 the first time that I saw it. I saw it run to 30 and 31, 32, 33. I was like, I'm not buying that. It's just a bit too high. And in hindsight, it's even more clear. It just ran too far. But now the reason why it's capitulating is because one, it's still correcting from that overextension to the top side. Two, in addition to that, you also have to think about the fact that they're not expecting their net income to grow this year. They're still expecting 2 interest rate hikes this year, which are going to, of course, hurt refinancing. People aren't going to be looking to do refinances. It's going to struggle, of course, with people to actually take out loans because these loans become so expensive. And that is not an environment that is conducive for growth when it comes to a company like SoFi. So people aren't expecting them to perform well this year. People, myself included, think, yeah, if they're going to do well, they'll do well next year, which is why I've told you all this is a 12 to 18 month play at minimum if you really want good gains, because you need to see an environment which is much more conducive for growth, which would also align with what I believe to be a potential crypto bull market as well, and middle to end of next year. And so people are looking at it like, I'll come back to this when the environment's a little bit better. I'm not doing that because I don't like trying to time bottoms. I don't know when SoFi is going to bottom. I don't know if the bottom for SoFi is in already. It could be, it could not be. I don't know. So my game plan isn't to go in and say, I'll go invest into these other things and then come back to SoFi when the time comes. I just go, all right, I'll just get in now and wait it out. That's my plan. It's a 12 to 24 month, 12 to 18 month plan that I'm personally implementing, which is the reason why on days like today, when we see it pull back and it's at $15.69 and it feels terrible and it feels scary, I'm not scared because I know this is a long-term play. And the further down this goes, the more opportunity that there will be for growth in the future once the environment is conducive for growth and the market realizes what SoFi's true capabilities are and where it should be fairly priced at. I think SoFi should eventually be back above $20 easily. And even if it goes back above $20 and stays above $20 from here, that is a 27% growth. That's 27% in gains. And so when I hear results like this today, I don't go, oh my God, why is SoFi falling even though it generated great results? I go, great. The market still doesn't recognize the opportunity that there is here for SoFi because it thinks it's overvalued, and they don't recognize what SoFi is doing in the back end, the infrastructure that it's building in the back end. And that is great for me. Now, I want one thing to be clear. I'm not saying that, I've said very clearly, I do believe that SoFi's fundamental value is increasing. I'm not saying that I think SoFi's fundamental value is up here. No, I think when SoFi was up here and up here, it was just too high. Maybe SoFi's fundamental value, its fair value is somewhere like here, right? Maybe it's something like that. Let's just call it just a random thing like that, right? Maybe that is. And for a while, we were just above it. And it didn't make sense, and we were overextended. But I now do believe that we are now falling in a position in which even if SoFi's fair value is something like this, right? Like something like that. Call it this. That's fine with me. Call it something like that. I still think we are now diverging. I think SoFi's fundamental value and its fair value is now separating from the price. And I think there's an opportunity being created here. And the lower it goes, the larger that opportunity becomes, which is the exact reason why this was initially going to be a $10,000 position. If we see SoFi for any reason fall into the sell to house to buy more zone between $14 and $11, I'll probably build in another 5 to 10K. And if for any reason whatsoever it falls below $10, I'll probably add in another 10K. This could end up being a position which I allocate $30,000 to, which is be 7 to 8% of my public portfolio, because I'm just that confident that what they're doing is going to work. And once the environment in which they are in is conducive for growth, I think it's going to represent that. They are growing on all accounts, across all metrics. I just think the market doesn't care because there's other more exciting opportunities out there for companies whose net income is climbing, which is totally reasonable. There are other better opportunities in the market this year than SoFi, for sure. For sure. That's not even really arguable. There absolutely are. I'm playing the long game. I'm not trying to play the short-term game. I'm playing the long game, and that's why I'm building into this position. And so that's where I am with this. I mean, it was an absolutely fantastic earnings. The market's punishing it anyway. It's just the market we're in. You just have to get used to that sort of thing. It's nothing new for SoFi. I mean, look at where it's been. Ever since it became overextended, it's what it's done. Boom, it fell there. Boom, it fell there. Boom, it fell there. Because you need to understand, retail doesn't care about SoFi. You know, one thing I looked up earlier was this. Look at the last 5 years. We are now seeing SoFi enter into one of the lowest moments that it's been to in the last 5 years. The last time retail cared this little about SoFi was back in the bottom of the tariff crash of 2025, right? Before SoFi ever even went on that run. The last time people were looking up SoFi as little as they're looking it up right now, the stock itself, was whenever SoFi was back at $8. Okay. And it just goes to show people are giving up, people are quitting. And usually that is one of the best opportunities to build into positions, which is exactly why I'm going in and building into mine. I'm building into my position at these lower levels. I'm just looking to see if it comes into my accumulation zone. If SoFi falls into my accumulation zone between 1550 and 1475, I'm going to be buying, and I'll probably deploy another $1,000 or $2,000, wait it out, see how it goes. If it falls below it, I'll deploy another 5 to 10 down here, wait it out, see how it goes. If it falls more, I'm going to go in. It's a 12 to 24 month play that I think will make me $10,000 to $20,000. That is what I'm expecting. And to me, it's like, yeah, cool. If I can make 20 grand, 10 to 20 grand over the next 24 months from one position in this macro portfolio, this public portfolio, great. Because then what I'll do is I'll probably end up rotating, and I'll put some of that profit into my long-term gains, and I'll let that ride for 30 years, ride 10 to 20,000 up, and call it a day. I mean, that's not unreasonable. That's not unreasonable. Say you drop, say it's 12,500 low side, monthly contribution being 0. I give it until I'm 30. No, I give it 30 years. Say I'm 55 years old. I rotate $12,000 of profit into my position. It does, let's go low side 8% interest rate, and I just let that sit. We're talking about, no, not 55 years until I'm 55. Hold on. No, so it'd be 28. There we go. 28 years from now, I mean, guys, we're talking about a potential $100,000, right? $100,000. And you could adjust that for inflation if you want. I mean, that could be 83 grand, right? Like, that's the sort of game I'm playing here. Generate the profit over a long enough period of time, rotate that profit into my long-term portfolio, and let that compound into 6 figures. That's the game I play. I'd rather play that game, the long game, than try to chase short-term excitement, because I don't trust myself to always predict what's going to happen in the short term. I don't trust myself. I've been in the market for 9 years. The more time I spend in this market, the more years that go by, the more I realize that I don't know as much as I thought I did. And basically everyone I know, what's that effect called? Connor talked about it on our seminar the other day. Something. It's basically like the more you know, the less you know, basically. And yeah, so I don't trust myself to know exactly what's going to happen. What I don't want to do is ignore SoFi, sell my position, go try to make the AI trade, make profit from the AI trade, rotate back into SoFi, ride that thing up, sell it, go into quantum computer. No, I'm not playing that game. That game does not work for 99% of people. And I'm not going to bet that I'm the 1%. Okay. And so that's the reason why I'm accumulating here. The market's punishing SoFi because it thinks it's boring. The market's punishing SoFi because it doesn't recognize the spread between opportunity right now. I do. And I'm going to give it time. Okay. So that's where we are with SoFi. We have been live. Yeah. Dunning-Kruger effect. That's it. Exactly. Thank you, Jacob. So that's where we are with SoFi. And yeah, we'll just kind of see how it plays out. So look, this is the game plan, okay? This is the game plan. I have been live since 6 a.m. This is my plan for the day. I need y'all to listen very closely. First and foremost, one thing I did want to let you guys know, by the way, the toolkit, it is still for sale. Feel free to check it out. Anyway, so this is my plan. I have a podcast coming up with the boys in 45 minutes. 1 second. Open Wallets podcast. I have a podcast coming up with the boys in 45 minutes. Okay. That's going to be in 45 minutes at 9 a.m. We're going to be going over SoFi. We're going to be going over our expectations for the FOMC. We're going to talk about Meta. We're going to talk about Microsoft. Okay. If you don't know what this podcast is, it's a podcast that I have with some of my friends. I'm going to drop the link to it down below. I want you guys there because we are going to talk about more of the stuff that's coming up through the rest of the day. I just put it in the description. Okay. I just put it in the description. Go there, meet me there in 45 minutes. We're going to do that. Then what I'm going to do after that ends, that'll be about an hour and a half. I'm going to take 2 hours off. I'm going to go get some lunch. I'm going to take some time. And then I'm going to be live today for a long time. We're going to go live for the FOMC meeting, which is at 1 p.m. my time, I believe. So I'm going to go live just before that. I'm going to start my live stream about 1:30. Let me see. Hold on. I'm going to start my stream. Yeah, I'm going to start my stream at 1:30 Eastern Standard Time today. Okay, EST. It's going to run through all of the FOMC meeting. So it's going to go through the Fed interest rate decision, FOMC meeting, roll straight into Meta and Microsoft earnings right after. Okay, so this is going to be like 3 hours that we're going to be live. I've already been live for 2 hours. I got an hour live on the podcast. I'm going to be live for like 7 hours today. So we're going to spend the whole day together, damn near. Okay, so what I want you to do is I want you to meet me on the Open Wallets podcast in 40 minutes. Meet me there. Then I'm going to go get some lunch, spend some time with my family. 2 hours later, I'm jumping straight into the FOMC. I'm going to make a live stream available, and I'll send out the link a little bit later. Okay, so meet me there. We're going to just do the whole thing together, folks. We're going to do the whole damn day together. I've told you all I am committed to walking you through this market. I'm not a financial advisor. I'm just literally a random dude, right? But I've been in this market for 8 years, 8/9 years. It depends on how you want to look at it. I've been through the worst times and some of the best times of the last 8 years. I've been there watching it happen, okay? And because of that, I've gained a bit of an ability to see through the bullshit and actually give you what's the information you need, okay? Or the information that I at least think is valuable. And so on days like today, where there's all this stuff going on, there's earnings, there's FOMC, I am committed to walking you through every step of it so that you don't feel lost and hopeless in these moments because they get sucky. When you're doing it alone, I was 19 years old when the pandemic started. I had no one to talk to about what was going on, and I watched my entire portfolio fall 50%. It was horrible. Okay, so I'm going to be here every step of the way walking through with you. And if you do want more, you don't need more. I'm going to be here 8 hours today. If you want more, a couple of things you can do. There's a link to TH Capital down below. It's the course community. There's courses. There's a Discord. There's live events, live seminars. It's like $30 a month. Okay. In addition to that, I have a toolkit. Feel free to check it out. That is also linked down below. It's what I use to do technical analysis. Okay. So with that in mind, that's it. Meet me on the podcast 45 minutes from now. Okay. 45 minutes from now. I don't know why this is not clicking. Give me 1 second. But yeah, meet me there 45 minutes from now. If you don't know where it is, the link is down below. You can go on YouTube and type in Open Wallets podcast. I did put the link in the description. Refresh it if you don't see it. I just put it there. Meet me there. I'll see you in the next one. Bye, everybody.